Hey there, welcome to saas.unbound podcast. I'm your host, Nadeina, how to growth at saas group, serial acquirer buying wonderful SaaS businesses to take them to the next level. And here I chat with inspiring founders and experts to get an inside scoop on how they made their business a success. And today with me is Pavel, head of M&A at saas group, the person that makes saas group a success. Welcome to the show.
Pleasure to be on this podcast, Anna.
Well, pleasure to have you here. I know how busy you are, but yeah, let's get to it. First, maybe a bit more about your background.
Great. Well, I've been the head of M&A at SaaS Group now for almost 3 years, this coming October. And originally, I started at KPMG back in 2011 as a graduate trainee. And I pretty much have been doing different kinds of transactions for the last 12, 13 years, initially as a corporate finance advisor, due diligence provider, and then spending 5.5 years in private equity. Firstly, investing in emerging markets like India, Colombia, China, and then investing in mostly high growth technology companies in the US and Canada. And about 5 years ago, I had an opportunity to join one of the operating groups of Constellation Software called Valeris, where I spent a couple of years buying mostly on premise perpetual license businesses providing mission critical industry specific software in the US and Western Europe. And after spending a couple of years there, I got approached by one of the co founders of SaaS Group, Tobias. I immediately saw an opportunity to achieve a 10x revenue from where they were at the time, to build the processes around deploying capital at scale very efficiently. And here we are now. We are about halfway through that journey of the last 3 years, and hoping to do another 2 3x over the coming years. And a big part of that is finding great companies that we can buy and scale over the next couple of years.
That's great. Yeah, thank you for sharing this. I didn't know some of this stuff actually, so it was really interesting. Okay, so I mean, we've covered quite a bit our acquisitions last year on the podcast. I would like to talk to you more about the most recent buys that we had. And we don't have to name any names because we haven't announced a couple of those. But yeah, tell me what you're most excited about buying businesses this year and what do you see going on the market in general?
Yeah, I would say that this year the market is a little bit tighter compared to last year, and we can see that by talking to various industry participants and also looking at some of the market commentaries. And in my opinion, one of the main reasons behind that is that the rates have been going up last year, and most recently they're going down again. So what it means is that a couple of things. One of them is, as the cost of capital is declining, people can afford to pay more. And secondly, when the sellers get a valuation in the market when the rates are declining, there's always an expectation, I can get a higher price just by waiting a couple months, regardless of the actual outcome. And so we see a lot more sellers holding back from accepting offers, regardless of the growth trajectory of the business. And therefore, it is a tighter market, but every M&A market goes through a cycle, and we expect the 2025 to be a lot bigger in terms of the acquisitions closed. As for us, we have closed 3 transactions year to date, all in Germany, and there's a mix of kind of ultra bootstrap companies, very, very efficient, profitable business with very low cost to serve customers, to a business that's a little bit more established, has been in the market for more than 20 years, operating almost a monopoly-like product. And a third one is a company that has an incredible product, growing 23% year over year, with a product that's primarily focused on DACH, but also has a potential to expand globally. But the theme is the same: is to find great SaaS products that can grow over the next 5-20 years, and obviously partnering with the founders, with the management teams, to help them execute that strategy.
Okay, that's perfect. Obviously, SaaS Group buys companies to hold them, to hold to them forever. And does that strategy impact the way you approach founders and SaaS companies?
Absolutely. So, look, there are various participants in the market for buying software companies, and I think the one of the biggest participants are obviously private equity that tend to buy companies that are larger and often growing faster compared to the companies that we buy. And private equity essentially makes money by buying and selling companies. So, in order to make money, they need to buy companies that either uh, grow faster or become more profitable and able to pay down debt. And therefore, when we look for companies, we tend to be in that kind of 2 to 10 million AR versus private equity tends to be kind of, 7, 10, 20, 30 and above. And so there are a lot of great companies where founders are willing to exit the business either because they want to retire or because it's one of the side projects for them or because they simply lack skills, whether their own skills or within the team, to take business to the next level. And therefore, they need a partner. And since they're often too small for private equity, or maybe they're not even growing fast enough for private equity, there are still great businesses, right? They have great products, great customers. They have very good net dollar retention. They are profitably deploying their marketing budgets to grow at a sustainable rate. And so this is where we come in. We essentially offer an opportunity for those founders to realize an exit and either sort of retire, move on, or stay and partner with SaaS Group to help them scale the business. So for me, it's rather the buy and hold here is probably less important. It's more the type of the market that we play and how we make money. We make money from the mix of profitability and overall growth of the business versus the private equity is looking to buy a mid-sized business, grow it, and then sell it for a higher profit. And therefore, if the business doesn't grow, they can't really make the economics work. Versus we're also happy to look at businesses that are maybe a little bit, where the growth is slowing down. And so in terms of rule of 40, they are more 40 than zero. And we're just happy to take that business, operate, and maintain their legacy.
Okay, since you already just mentioned the rule of 40, and obviously we've been talking about it forever, and now, like on this podcast, I've started asking like, what was the metric that founders are now looking into in comparison to last year or the year after, the year before that. And the rule of 40 was, I think, number one that everyone mentioned, which was a little bit different to even last year, to the answers last year. Why is that happening? Why even founders, not just M&A guys like us, are looking into this metric?
So, in very simple terms, if you have a company that's not growing, you should be making EBITDA of at least 40%. That's how we think of it. It's a little bit different for venture capital because, like, you're burning free cash flow and then you're growing like 100%. So, if you're burning minus 50 and growing, plus 100, then you're like at a rule of 50. But for us, it's kind of if you are flat, if you're just cash flowing either because it's quite a legacy product or because the cost of acquisition is so high that you're better off just taking the profits instead of reinvesting. You should be at 40%. And if you are growing, say 20%, you should at least be doing 20% EBITDA margin. Now, what we see in practice that for many SaaS businesses, this rule doesn't actually work, right? So we have seen a lot of companies that are maybe a little bit subscale, let's say around 2 to 3 million AR, and companies that are mostly doing sales-led growth, right? And usually a lot of them are at around 20% year-over-year growth and 0% EBITDA, which is the worst place to be in because you're kind of growing, but you're not growing efficiently because you can't make profit. So you are kind of rule of 40 is 20. And what we've seen those founders and their VC backers or if they're bootstrap, just the management teams, they basically try to cut the costs to get to a profit. And instead of ending up with 2020, they usually end up with, say, 1010, right? So they cut the costs and they grow less than before in order to make a profit, which basically tells you actually your business is not capital efficient, right? Compared to, say, other businesses where if you're able to cut some of the costs because you have very high net dollar retention, very low cost to serve, you're actually able to get to rule of 40. So everyone is talking about it, and a lot of brokers that are selling businesses that tell you, hey, yeah, by the way, we can just cut the costs and get to a very high EBITDA margin. The truth is, they will probably end up being flat, or the growth rate would tank significantly. So the actual rule of 40 is very hard to achieve if you haven't been doing that before.
Okay. Any other metrics that you prioritize when valuing a SaaS company?
Yes, I would say net dollar retention plays a big role. We at SaaS Group are looking at two type of businesses. We're looking at businesses that have a self-service product-led growth, like go-to-market motion, where you mostly customers find you through SEO or through paid search or through YouTube, WhatsApp, etc., where the customer acquisition cost tends to be quite low, but also the ACV tends to be quite low. So that's kind of one bucket. Another one is more established enterprise SaaS with ACV starting from 10,000 euros and above. And so when we look at these two categories, we have kind of a net dollar retention targets as well as gross dollar retention targets. And again, to there are and we're looking for number that's I would say starts with 90% for either of them, right? So at least a 90%, maybe around 85%. It really depends on how capital efficient is the business. But for PLG SaaS, you tend to have net retention that's a little bit lower because you have a lot of small customers that are constantly trying your product, and then there's quite a high drop off after months one. Versus for enterprise SaaS, you really need to have a net dollar retention closer to 100%. And we see a lot of targets right now that are coming to market that are actually quite sizable companies that are doing enterprise sales, and they have often net dollar retention like in the 70s. And for me, that's a pretty bad business, because it tells me that there's probably a limited product market fit, and therefore, if you continue cutting the costs, you may actually end up having a shrinking business. So yeah, net dollar retention is probably the single most important metric that we use to qualify the attractiveness of a company for SaaS Group portfolio.
Interesting. So obviously, when you're trying to sell your business, or if you're looking for investment, either of those scenarios, you need to get your metrics ready and to have the documentation that you then present to the acquirer or the investor. And just today, I was looking at this video from Ben Murray, the SaaS CFO. If maybe someone in the audience knows him, and he was talking about how long, on average, a founder needs to prepare the documentation for when they are looking for an exit. And he stated it at 3 months. What do you think? How long do founders actually need? And what is the best time to start preparing this documentation if exit is something you're looking for down the road?
Look, it's a very interesting question. I personally don't think there's one single answer to this question. The analogy is that there are some people that clean their room every single day. They make their bed after they wake up, but there's some other people that just like do it once a week. And there's not necessarily a correlation that one or the other are more successful in their life, right? It's just like it's a hygiene factor. I would just say that the people that really succeed at running their business, they have all their SaaS metrics, they have their cohort data, because that's how you make a decision whether you want to invest. And a lot of times you find that founders neglect those things. They still have a very successful business with great metrics, but then it gives us an opportunity to come in and do better, right? To do better marketing, to do better product, better onboarding flow. So that's it. But I would say that it's good for founders to definitely prepare, talk to us. I mean, we can give them some checklists, but even if they don't prepare, I mean, we will just spend a little bit more time working together, getting all the files in place. And for example, what we like to do is when we look at a SaaS company, if they don't use a tool like ChartMogul or similar, we can simply get a raw invoice data, and then our BI team can process, create very nice dashboards. We can then share those dashboards with the founder and tell them kind of, hey, this is what we're seeing. Do you agree with those observations? And because ultimately founders have their own processes, and we don't necessarily want to kind of disturb their process while buying the company.
Okay, yeah, thank you. All right, something else I wanted to ask you. We already touched upon it a little bit previously. It was about the deal flow and the volume of the deals in 2024. And it was kind of expected. The predictions were that it's going to be a much better year than even 2023. But I kind of see the trend there of companies. Profitable, really growing SaaS companies buying smaller tools to add to the product, and quite a few serial acquirers or wannabe serial acquirers popping up. What do you think is the reason? Like, what's the trend with micro acquisitions and add-on acquisitions? And yeah, why is serial acquisition becoming popular in a way?
I think there are several parts to this question. I would say that strategic interest has always been there. I've seen it last year, I've seen it this year. And strategic transactions are where usually private equity buys a SaaS company and they want to find ways to grow faster. So they would be buying companies at a price lower what they paid for the asset to essentially realize a multiple arbitrage. And the challenge there for the founders is that usually they just want to buy one company in a specific niche. And so if you are talking to one of the strategics, they're probably also talking to 20 other businesses, right? So something to be mindful. I would say that if I take a look at the private equity market, right, the private equity is usually being analyzed by vintage, right? And when you go through periods of extremely low interest, people are forced to deploy a lot of capital, right? That's what happened in the last couple of years before the interest rates were increasing. And what's probably going to happen is that the deals from those vintages, they would underperform quite significantly because people have overpaid, the market has readjusted. You probably wanted to sell your company at X, you would sell it at 0.7x. And I feel like it's the same for serial acquirers. And I'm talking about serial acquirers that are not the micro SaaS movement, but rather big, well-funded serial acquirers that raised a ton of capital, a lot of equity, say last year, and now they are actually forced to deploy that capital in order to justify the economics for the investors, right? And so it is quite possible that those acquirers that raised a ton of capital that deployed it are forced to deploy. They may end up overpaying, and therefore the cohort from this year will not be as successful. Again, it's just a speculation, but looking at SaaS Group, we obviously have a quite a long-term capital base, both equity and debt, and we are really, really cautious. You know, we would rather do no deals this year than do the deals that we would regret. So that's quite important. So even if somebody is doing more deals than us, that doesn't mean that they are better than us. It's just possible that their investors are telling them, "Hey, we want to see the return, so we want you to deploy as fast as you can," which is not the same for us. We are a little bit more cautious. And finally, micro SaaS movement is something that we are seeing over the last couple of years. I would say that in the US, the micro acquisitions have been around for a very long time. There's quite an established funding base for such acquisitions. For example, the SBA loans allow a lot of Americans to buy HVAC contractors, laundromats, vending machines, etc., with pretty much no money down. And there's a lot of people that write about it, like Cody Sanchez. I think she owns a lot of like boring businesses, and there's this whole boring business movement. So for me, the micro SaaS is just basically taking that business model and starting doing SaaS instead. And by micro SaaS, we really define people that buy very small apps where you buy an app with like 10K MRR, 20K MRR, then you try to grow with 4-5x. Because if you're buying like a laundromat, you can't like double the revenue of that business because you have like the fixed asset and the number of people that come to wash their clothes is pretty much the same every year. But SaaS, you can kind of buy 10K MRR, you can do some growth hacking, and you can get it to 15, 20, or 30K and then sell it for quite a big profit. Obviously, in our business, where we buy companies that are 2, 3, 4, 5, 10 million AR, that are growing 10-15%, it's quite hard to do the same, and you also need a lot of capital to do that, right? Very few people can afford to pay 10 million or 20 million dollars and guarantee to close within 8 weeks. So it's a little bit of a different market. The people there make a lot more noise because it's a growth hacker type of market where people obviously want to attract attention also to the product that they're building. And therefore, even though there are a lot of entrepreneurs going into micro SaaS, it will very few of them would actually be able to go up market and start buying companies in kind of a 3 million AR and above.
Okay. Well, let's talk about cautious, right? AI acquisitions. Are we being cautious about them? And what do you think in general? Like, are we treating them like a hot potato? Are we stalling? We're not. We're just looking how everyone else is doing with them. What's the deal?
So at SaaS Group, we are looking to accelerate companies, not to create the future, right? The future is being created by entrepreneurs that sell to SaaS Group. And one of the hard criteria for SaaS Group in buying a business is that we would only buy a company that's at least 5 years old, ideally 7 years old. Again, because we're not doing 0 to 1, we're doing 0 to 10 or maybe 0 to 3, right? And therefore, most of these AI companies that are within our size bracket, say 2-3 million AR, they could be 2 months old, right? And even though it fits the size, it doesn't fit the criteria of age, and it also doesn't fit the criteria of net dollar retention. If you grow from 0 to 2 million with 5,000 customers, your net dollar retention is going to be closer to 0 than to 100, right? Just because like a lot of people are trying, they're going through word of mouth, virality, etc. And so it's possible that once the AI apps become a little bit more mainstream, meaning 5-6 years from now, we'll be able to buy companies that have already proven themselves, that are growing. Because remember, we don't need to buy the best, the latest technology. We're just happy to buy great products that are niche, have a defensible niche within a subsector of the economy, and so on. So that's probably, but at the same time, we do have a head of AI within SaaS Group, and we are introducing AI within almost every single business that we have at SaaS Group. For example, ZenLoop recently launched. ZenLoop is a customer experience platform, customer feedback platform. They recently launched ZenLoop 2.0, which is based on AI. We're introducing AI into every other business, also within SaaS Group in terms of customer support, customer success, finance, reporting. And so we're happy to use AI to help us, but we perhaps not yet ready to make a judgment call whether an AI copywriting app would triple, or whether it's and there's a lot of apps that don't really have an IP. It's just another way to use ChatGPT through a different interface, right? And obviously those companies are the ones that are, yes, they can scale to quite a big revenue. They have very high profit, but it's just hard to see whether they would go up, down, and kind of, we're in the business of buying more mature companies.
Okay, thank you, Pavel. So obviously, we as serial acquirers mostly talk about the way we buy companies and what we want to see from the sellers. But yeah, there are certain risks that we have as buyers. But what are the risks of the sellers selling to companies, even like us, just selling their companies? What should they be aware of, and what would you recommend founders do before they decide to sign an LOI with anybody?
So, a couple advantages of selling to SaaS Group is that we tend to buy 100% and we offer real cash on day one. You know, sometimes cash on day one, sometimes it's there are like a sort of deferred consideration that's 2-3 year deferred, so-called seller financing, right? The mix depends on what stage the company is, how quickly it's growing, whether the founders want to stay or not. Let's maybe compare a couple examples. If you are selling to private equity rarely buys 100%, right? They could buy 51% and ask the founders to roll over their equity in a new vehicle, and they would also structure their investment as a preferred instrument, meaning that if the company doesn't grow fast enough, you could actually lose the other 51%. You would just get the 51%, right? So we tend to give the sellers peace of mind that they will get their money, whether all at closing or in payments within a couple of years, but it's quite safe, and we are big enough to be able to provide those guarantees. Another example is when founders are selling to a strategic buyer, and like you said, Anna, where the buyer wants to add, uh, for example, it's a CRM company that wants to add email marketing functionality, right? And they're not really buying a separate product, they're just buying a feature. And what happens usually in those cases, sellers don't get all cash. They tend to get cash plus shares, and that could cause tax impact in certain markets. And also, it is possible that after 1 or 2 years, the new CEO joins the strategic and they realize, actually, I don't want to do email marketing anymore. I just want to focus on CRM because the cross sell thesis doesn't work. And then what happens is that they basically fire people, they run the product in maintenance mode, and the founders don't get their earnout. And then guess what? The strategic equity was overpriced. They do another round, and it's a down round, and so they lose like, one third, two third, or the entire purchase price that they got. So you get those risks. I mean, not with every business, but something that you need to be aware that SaaS Group can offer a certainty of consideration. We can also offer you the independence, right? We can have certain guardrails that we can't take the people away from the business during the earnout period. And we don't, right? We let the brands operate independently to make the decisions independently. And then we bring people, whether it's on the marketing side, DevOps support, to help them grow faster. And therefore, I view this as a lower risk. But I'm also mindful that a strategic that desperately wants to add a particular feature, they may pay the price that's nothing to do with intrinsic value, but it's just because they need it quick. But yes, I mean, the high price usually comes with high risk.
Yeah, that makes sense. So, what kind of due diligence on the buyer would you recommend founders do?
Source of funds. Does the buyer actually have money? There are many different buyers out there. There are searchers that we see actually quite aggressively bid on assets in the US. So a searcher is somebody that raises capital to find a company to buy, and once they found the company, sign an LOI, they try to raise the money. And very often, if they're too aggressively negotiating the price, the investors don't like it, and so they basically lose the deal, and you end up like wasting 3 months. Also, I would be very cautious with strategic buyers, because let's say if you're buying, negotiating a deal around their quarterly results, especially if it's a public company, if the market reacts negatively, share price goes down, the CEO might say, okay, maybe we shouldn't close a deal, let's kind of wait. And so you wasted another 6 months. So spend some time understanding, does the buyer actually have the money, or is it like a shell company that will raise the money for the deal? And in our case, we have money fully committed for every single acquisition that we do. And then figure out, why do they want to buy your business, right? Are they buying because the CEO likes to pivot to a certain strategy? Because you can't be at risk of, like I said, either getting too much stock and the strategy not working out, or the buyer walking away just before the notary because they had a very bad quarter, or because they need to write off some of their receivables, whatever. And so there's a lot of uncertainty. Versus with someone like SaaS Group, we just buy great companies, we let them run independently. So the only reason for us to walk away from the deal is that if we find things in diligence that are there are negative findings. Like, for example, if the founder tells us that his net dollar retention is X and it's actually 0.5X, that's a deal breaker for us. But the change in the market or change in the weather or me having a bad day is not going to make a change to the way I run my acquisition processes.
Shocking. But thank you for walking us through that. All right. Well, I just have a couple more questions. I think it will be super hard to judge, maybe because we've had quite a bit of successful acquisitions and some other really positive things happening in SaaS Group. But what's so far your biggest win?
I feel like since I joined, we have managed to build one of the strongest M&A teams in the market. And that, I feel like, touches all the areas from the top of the funnel, including having someone like you working with us and helping us build the founder community, help us do the events. A lot of times, people that want to work for SaaS Group, they tell us, hey, I saw your LinkedIn post, or I saw the Anna's podcast, right? So people really start treating SaaS Group as a lifestyle brand, and we want to be in that SaaS community to be the not the acquirer brand necessarily, but like the brand that associated with SaaS, like the SaaS talk, SaaSter, and events like that. Secondly, on the origination, we are seeing an incredible number of great businesses, so we are really privileged to be able to meet with a lot of great founders and really choose the brands that we really like. So having be able to choose means that we don't have pressure to go for inferior assets. And finally, I would say just as a team, we work really well. We speak multiple languages. We work fully remotely with great NPS. So I'm very happy with where we are today. And in fact, actually, we are looking for more roles right now. We're looking for an M&A operations role, and we will shortly start recruiting for a senior business development rep. And so the people that are very excited about SaaS Group, love talking to founders, like bringing deals, should absolutely reach out to us and apply.
Yeah, I can totally back this up. It's a pretty cool place to be. Any failures? Anything? Any regrets, mistakes, challenges, learnings?
Yeah, I think when you pursue a serial acquire strategy, there will be things that don't work out, and we have situations where perhaps either the economic environment or other changes have made things a little bit more difficult. That always will happen, but the goal is to become more mature and have less, let's just say, failures, more successes in the future. But I feel very happy about SaaS Group because we have very good people and very good processes to really go out and help brands that are maybe a little bit behind the curve, but also help brands that are ahead of the curve get even higher. And by when you balance kind of all of that all together, I feel like you get a very strong portfolio that delivers strong organic growth with very good level of profitability. You get that community feeling within the brands, and that means that everybody can get elevated, and that's kind of what I really enjoy. And this goes beyond me. This goes into the board, our central teams, and every single employee of SaaS Group. All working together to make us stronger.
Yeah, I know it sounds like a little too much, like we're advertising SaaS Group way too way too hard here. But actually, I had a really big privilege of traveling a little bit through Europe last spring and meeting with a few people who have joined fairly recently. And there was one comment that was the same pretty much throughout every conversation. It was, it turned out to be so cool, it's even suspicious. So, yeah, it's I can totally relate. I felt the same too. So, yeah, act on it. Pavel is hiring. You should definitely join. All right, the last question is about a hack, and it can be a hack that works, that you see working for founders when they're selling a company, or that you use something, a little something that you use when you're looking into a company that tips you off that this is the business you want to buy.
So we at SaaS Group, like, how Cody Sanchez talks about like boring businesses, we like simple products, right? So, again, I'm open to looking at every company, but if your product takes 2 hours to explain what it does, right, then it's probably not for us. We don't like companies like. There are better buyers that would love to buy a core banking software with AI enabled back office, whatever, right? Something that I won't be able to explain to my grandmother because it's so complex. We like companies where founders find, well, founders have a real pain in their day-to-day life. I mean, let's take one of my favorite brands, My Works, by Peter Leonard. Peter used to run, I believe, a web design or hosting company, and he was selling his services through WooCommerce and using QuickBooks for accounting, and he had to like manually enter receipts into QuickBooks. It was very hard to reconcile. He's like, oh my God, I just got to build something. So he built an amazing tool that has thousands of customers. Now we do WooCommerce, we do Shopify, we do Xero, QuickBooks, and it's just it's a hard product to buy, but the beauty of it is that it's a simple product that everybody understands. It has a very clear ROI, and so if founders have products like that, we want to hear from them, because this is where we really like to add value. Just try to make it simple. I feel like a lot of founders are, especially the ones that are coming from the industry, they try to solve a very hard problem, right? And for that, they may need to raise money from very, very deep tech VCs. Versus if you are selling a very simple problem, then it's easier to sell your product. You have virality, word of mouth, you have online marketing, SEO, and then you can scale your business with a 50% EBITDA, collecting a lot of money along the way, and then sell to someone like SaaS Group and will help you double, triple your business. And so for me, we would love to hear from founders that have done that. But equally, if your business is a little bit more harder, still reach out to us and we'll see what we can do for you.
We'll simplify it for you. All right. Well, thank you, Paul. It's always great to talk to you. I feel like you're one of the biggest evangelists of what we're doing at SaaS Group. So that's always really cool to learn more about. Anyway, thank you so much for being here, and happy to do it again sometime.
My pleasure, Anna.
Thank you, and take care.